Good afternoon, everyone, and welcome to the first quarter 2017 Capital Market Review. Before we get into the material, just wanted to remind everybody that the information you're receiving is my opinion only, not that of Raymond James or Raymond James Financial. As we do every quarter, we identify a theme or a title. Today, I think we're going to call this Selected Opportunity. What I mean by that is, while the Trump administration is certainly going to try to expand the economy through fiscal stimulus, not everybody is going to be a winner. And we'll see if we can vet out some areas that might perform better than others. We do this because we believe the economy matters. And what we're going to do is try to dissect economic growth, the job market, where corporate profits are and where they might be, where inflation is, and what will happen with interest rates and what its bearing will be on the economy. We do this in an attempt to answer, where are we right now, and more importantly, where are we heading? When we manage money, we try to answer two questions. One, where are we in this economic cycle? And two, where's the Fed? In terms of economic cycle, there are typically four phases: a recession, a pretty steep recovery, a mature or economic slow growth period, followed by an aging or economic slowdown. One would expect that we're probably in the, since this is the 8th year of the economic recovery, we're probably in that slow growth mature market. But now, with talk of fiscal stimulus, we may actually be in a position that feels a lot more like late stage recovery. And then the other question is certainly, where will the Fed be? What are they more apt to do? And the expectation is they will once again continue to increase rates. Our hope is by doing this, we can stay balanced, we can stay diversified, and most importantly of all, we can stay invested. We have 4 topics to discuss this quarter. We'll do a brief quarter in review. We'll then talk specifically about the U.S. economy, the global economy, and then where is the Fed and what, if any, threats we may be facing. So let's start by looking at the S&P 500. This chart, which shows the S&P over the last nearly 20 years, all the different inflection points, we can see from the low of the market right here to present day, the market is up, let's say, 250%. And it hasn't been a smooth ride. Certainly, we've had robust growth toward the end of last year. But prior to that, from about fall of 2014, right up until about fall or so of 2016, there was about a 2-year period where we had very little growth. In fact, the S&P barely moved at all. Over the same period of time, the market has somewhat been stretched. If we look at PEs, or price earnings ratio, we're at about 17.5 times earnings. That is, by historic standards, a bit high. Now, that being said, if we were to look at current PE compared to the 25-year trend line, we would say the market is somewhat expensive. If we compare that, however, to dividend yield, we can see that when you compare stocks to bonds, stocks are not nearly as overpriced as one would think. But the markets are somewhat priced to perfection, and the expectation is they could go higher with greater fiscal stimulus. But we certainly have to watch where we are. And what I mean by that is when we start looking at PEs, you'll see that in every single case, large, mid, small cap, value, or growth, valuations today are quite a bit higher than what the long-term 15-year averages have been. In fact, when you look at large cap growth, the markets are up over 100% from their previous peak, which was October of 2007. And that's important for this reason. Better opportunities may be ahead in other parts of the world. This chart shows the Morgan Stanley Capital EFI, or International Index, at those same inflection points over the same 20-year period. Today, their markets are up about 100% from their trough instead of nearly 250 for the US, and valuations today have not come back to the previous high. US markets are up over 100% from that prior point. So valuations may actually be a bit better elsewhere. The other thing we need to talk about is interest rates. And as you can see, interest rates are now beginning to trek up a little bit. Still, on a relative basis, rates are certainly low compared to the last 35 years. But these trends, as they do start to develop, tend to be long-term, and as a result, there will be a significant headwind facing bonds and bond investors. The first time we've seen a significant headwind in 35 plus years. So the best place to talk about our economy is what's happening with the Federal Reserve and the Federal Reserve's balance sheet. The left-hand side of this chart talks about the federal budget. And this is all the different spending that the government is expecting to spend money on this coming year. This column here represents revenue sources, or taxable income, Social Security, insurance tax, etc. And you can see a sizable box that needs to be filled. That will be filled by additional borrowing or adding on of some degree of debt. Our budget is expected to create a deficit. We saw the budget drop with an increase in taxes under the Obama administration, Obamacare, and now we're beginning to see the deficit increase a bit because of this shortfall that we expect from taxes as well as spending. But more importantly, if we consider the Trump administration and the fact that they plan on cutting income tax, both personal and corporate, and at the same time increasing spending both for border protection as well as infrastructure and defense, this slope of this line, the effective increase in deficit, may in fact be a bit greater before additional tax revenues kick in. This slide talks about the economic growth and the composition of GDP. The big takeaway here is we have had, since the Great Recession, very anemic growth. The average has been about 2%, and that is really low by historic standards. The thought is, and the hope is, we may see greater GDP growth this year. We expect to see much better growth out of consumers. We should see greater government spending in terms of defense, border protection, etc. And with a resurgence in economic activity, we may see corporations spending more on investment in plants and equipment. As such, we could see our economy grow at 2.5% this year, and maybe as much as 3 or 3.5% next year, depending on the size of the fiscal stimulus. If anything, we certainly know that it's going to be much more difficult than originally expected for the Trump administration to get a lot of this fiscal stimulus through. We already saw a false start with the retracement of Obamacare. Obviously, both sides of the House are not playing well together. And even if we had a more diminished view of fiscal stimulus, it should still be somewhat additive to the economy. So this is certainly a hopeful thought that we may, at least for the next year or so, grow at a faster pace than the 2% or so that we've seen of late. This slide discusses unemployment and wages. A couple of really interesting things. The unemployment rate now is down to 4.7%. Growth or wage rate increase has been averaging now at about 2.5%. In fact, it has steadily started to increase. So a couple of issues. If we do see a high degree of fiscal stimulus, we may actually see the unemployment rate dip below 4%. If that does, undoubtedly, we're going to see wage rate pressure. Another way of saying that is we're going to see wage-based inflation. And this will be the first time we've seen that in quite some time. So while commodities haven't done particularly well, and we're not advocating that we run out and buy them, it's important to kind of take a look with a watchful eye on how commodities act over the next year or so with the specter of higher inflation. Corporate profits are certainly recovering and recovering pretty quickly. They've recovered quite a bit from the big drop that we saw in 2015. A lot of that is a result of an improvement in energy and oil. The US dollar has had somewhat of an impact on corporate profits. And in fact, when you consider S&P 500 revenues, nearly 44% of those revenues are overseas. A strong dollar somewhat hurts U.S. companies' foreign revenues. And as a result, we're certainly seeing that here. And that should continue for some time. The one thing that might help S&P earnings is the retracement and the improvement in energy sector earnings. They were really a huge underperformer for the last several years, and they're beginning to improve pretty dramatically. And because energy is still a very large sector of the U.S. economy, this improvement here can certainly offset some of the headwind here, and we may in fact see this projected improvement in corporate profits. We talked a little bit about inflation when we talked about unemployment. We're beginning to see, though, that the headline inflation numbers are beginning to tick back up. That's this blue line that we see here. The gray line is core inflation, which is tracking at about 2.2% through February, whereas the headline inflation number is almost 3%. And the reason for that is it's getting a little bit of stimulus because of housing prices, which are increasing, as well as energy CPI. If you look at energy, you'll notice that energy CPI through the first of the year has increased nearly 15%. So that's skewing the headline numbers. This is something to look at because we really haven't seen a whole lot of inflation the last 10 plus years. And in fact, we really haven't been close to the trend line in a while, but these numbers are certainly beginning to trend up. So we'll need to take a closer look at that as well. Let's look at the world beyond the shores of the U.S. This map we've looked at before. It's affectionately called a heat map. And this chart, let's just say green is good. So if we start looking here the last couple of months, in particular, most of Euroland, countries like UK, Euro area, Germany, France, Italy, Spain, all of these are solidly in the green. What this does is this represents manufacturing activity. Green would be 50% or more. Whenever you have 50% or more, you have economic expansion, and we're seeing very robust expansion in the international markets the last couple of years. Now, part of that is they have a huge tailwind, which is effectively the relatively strong US dollar and the relatively weak euro. So as a result, on the global platform, European manufactured goods and services are just simply less expensive. So we think perhaps a trend may be shifting, and as a result, we may start to see the international markets pick up and start to perform a bit better than the U.S. markets. So let's get back to the U.S. and in particular the Federal Reserve. Fed interest rates are starting to rise, and we expect the Federal Reserve rates to continue to rise pretty significantly. Now, there seems to be a bit of a dislocation between where the Federal Reserve expects rates to be and where the general market expects rates to be. Part of that is the uncertainty over economic growth. We still have a somewhat benign, anemic growth rate to our economy. So the bond markets are pricing in a bit shorter, a bit shallower, less robust increases in interest rates compared to what the Federal Reserve is currently expecting. If, however, we do see an improvement in economic activity, The bond market may very well be wrong. It may come as a bit of a surprise to the bond market, and the bond market may actually see somewhat of a negative reaction to that adjustment. But the expectation is we should expect to see an increase in rates in just about every public Fed announcement, and that there might be as many as 2, possibly 3 more rate increases this year. Now, to date, I think we had 1 rate increase last year. We've had 1 this year. So 2 over 2 years, we should see those come in at a much more frequent rate than that going forward. So what does that do to bonds and interest rates? Well, this map shows the historical impact of Federal Reserve tightening. Once they start tightening rates, they tend to do it for an extended period of time. As I said before, we expect multiple rate hikes. For example, when they were hiking rates in the early 2000s, that was 17 rate hikes over 2 years, 6 hikes over 11, 3 over 16 months, which is kind of where we are presently. And we expect that to continue. If we look down here, we'll see generally whenever we do see these large periods of rate hikes, the U.S. market, the S&P equities, can do reasonably well. But the bond market generally shows very little performance. So we want to stay away from long-term U.S. government bonds. We would rather own higher yielding bonds or corporate bonds as opposed to governments, because they tend to be a little bit less sensitive to rising rates. We looked at this chart once before, and again, even though interest rates are starting to rise, the takeaway on this is although the stock market is somewhat expensive, when we start looking at dividend yield as it relates to earnings yield, the market is about the same as the 25-year long-term average. It is not ridiculously overexpensive as it is in other categories. So as long as interest rates don't move up significantly, the market is going to be a more favorable asset class than bonds. And that might very well be the case over the next year or two. At some point, higher yielding bonds, even though total return may be somewhat flat, will start taking away from the stock market. At some point, people will feel more comfortable locking in higher yield than taking the variable chance of an equity market. But that's probably a ways off, as we've only had 3 rate hikes under our belt at this point. This slide also suggests where we might see better opportunity. As I said before, the international markets seem to be doing well. Europe, especially in terms of manufacturing, is certainly doing well. And when we look at the international markets and we compare their PEs relative to the U.S. market, we're certainly seeing many of these trading at far lower PEs, perhaps better value for one's investment dollar. So we want to consider the international component of the portfolio as well. Let's talk about threats and opportunities for just a few moments. This market has gone a long way. It is certainly richly priced, but not problematic. The values today are stable as long as earnings come through. But because of where values are today, things are certainly priced to perfection. Anything that would come out that would dissuade us from the expected may cause some pullback in this market. I'm saying this not because I expect a pullback, but because I want to make sure that we're all prepared for one. A pullback is not a recession. We don't expect a recession in the near-term horizon, but a pullback we could see at any point in time. Again, going back through history, looking at the S&P 500 as represented by those gray bars, you can see many more bars above the horizon than those below the horizon. Those above represent up years, those below represent down years. Effectively, there are a lot more up than down years. The dot beneath represents the yearly pullback, the amount of pain that one would have suffered sometime throughout the year. The interesting point is every single year there is some degree of pullback. The average pullback over that 37-year period is nearly 14.1%. And yet, there are many years that had a significant pullback and yet a positive response. So the issue is much less to do with eliminating drops and pullbacks, but rather eliminating big drops in capital that come every so often. So as a result, what we're trying to do is eliminate big drops. Now if we look at this next chart, it'll go back to just about the time of the recovery. Every year there seems to be some panic, cause, or pullback. By eliminating big drops and trying to insulate ourselves somewhat against the shorter drops gives us a lot more staying power. And that's what we try to do with our portfolio management. This chart shows all the big recessions that we've had going back to the Great Depression. The average drop during a bear market is 45%. The average duration is just over 2 years. Our approach is to avoid or attempt to avoid these big drops by using things like 250-day moving averages or using what we refer to as our bend but don't break approach. And as a result, we're still going to suffer drops in capital, but we're going to eliminate or prevent big drops in capital, which could potentially hurt the account for a long period of time or potentially cause a extended period of time needed to recover from such drops. And the best way of doing that is to maintain a well-diversified portfolio. Our approach is not to chase markets or chase hot areas, but rather own a well-diversified portfolio. If we look at this, which looks kind of like a periodic table, this goes all the way back to 2002, and you can certainly see where winners one year become losers the next. These that are out of favor become winners over short periods of time. If we simply chase that, our returns would be horribly poor over an extended period of time. But running a well-balanced portfolio that owns a number of these different categories and adjusting them periodically to economic changes gives us a return that is far more moderate instead of the big wild swings, and over time delivers a solid return with much, much less volatility. And that's what we're attempting to do with our portfolios, especially what we would call clients' serious dollars, which are generally retirement-based assets. So with that in mind, if you have any questions, please let us know, reach out, email me, and we'll be certainly able to answer back to you directly. If you know anybody who might be interested in a second opinion or to get a better understanding of what we do, we certainly would love the opportunity to speak to them. And as always, there are certain disclosures I want to make sure everybody has a chance to read. These define the risks and the disclosures of many of the items that we spoke about today. If anybody would like a complete copy of this, they can certainly request it. They can also save it. I want to thank you for your attention. We'll do this again next quarter. Have a great summer. Thank you very much.